Welcome to Investing Path, where we take you on a journey towards financial freedom. Today, we're thrilled to share some incredible source of wisdom from Peter Lynch, and we will be hearing some insights as well on the current state of the economy. As we all know, inflation is high, interest rates are squeezing consumers, saving rates are low, and the stock market is still down versus 2021. But fear not, because we've got Peter Lynch here to guide us through these turbulent times. Peter has been in the business for over 50 years, and he has seen it all. In fact, he managed the Magellan Fund, growing it from $20 million to $14 billion in 1990. Meanwhile, Peter shares his thoughts on how he can use these tough economic periods to our advantage. He reminds us that we've had 13 recessions since World War II, and we've had 13 recoveries. So, if this is a recession, it is probably the most predicted one ever. In fact, Peter believes that there's always something to worry about in the economy, but that shouldn't stop us from investing in our future. As we delve further into Peter Lynch's insights, we discover his resilient perspective on navigating through challenging economic times. While it would be convenient to have a crystal ball predicting future interest rates and inflation, Peter reminds us that such foresight is simply not possible. Instead, we must adapt, roll with the punches, and remain true to our investing strategy, regardless of the macroeconomic climate. Interestingly, Peter takes a playful jab at those investors who are panicking in the midst of this recession. In reality, the current situation isn't as dire as some may think. Interest rates has peaked at 9.1%. Interest rates hover around 5%, and unemployment stands at a relatively low 3.5%. Peter contrasts this with the recession of 1980 and 1981, where inflation reached a staggering 15%, interest rates soared to 19%, and unemployment surpassed 10%. Growing from this historical perspective, Peter reassures us that if we weather that storm, we can certainly weather this one too. As investors, we must resist the urge to succumb to panic and instead maintain a long-term focus. Peter reminds us that throughout history, we've experienced 13 recessions, and with each one, we have managed to recover. In fact, he shares that the only one time we should truly worry is when there's nothing to worry about at all. So in short, it is crucial not to let panic guide our decisions. Now let's shift our attention to what Peter Lynch has to say about identifying promising stocks. When asked if his pioneering investing style still holds up in today's market, he responds with an enthusiastic and resounding yes. According to Peter, finding exceptional stocks requires a keen eye for something different. We need to look for companies with captivating narratives. Take TJX and Stop and Shop for instance. Who would have guessed that all these local companies would experience a jaw-dropping 50-fold increase? That is the beauty of identifying turnaround stories and companies poised for significant growth, like Panera or Family Dollar stores. Peter advises against immediate purchases, but these are the kind of opportunities that have fueled his success. While some well-established giants may have lost their shine, new players continue to emerge. That's the nature of the market. We must remain vigilant in our search for these exciting prospects. Additionally, Peter emphasizes the importance of analyzing a company's balance sheet. If we can add 5 and 5 together and come reasonably close to 10, it is time to delve deeper into the financials. For instance, imagine two struggling companies, both seeing their stock prices drop from 50 to a mere 3. However, one boasts positive cash flow and no debt, while the other is burdened with significant debt and no cash. Which one would you choose? The answer becomes clear when we consider these factors. As we understand Peter Lynch's insights, we uncover valuable knowledge on investing during recessions. One crucial point he emphasizes is the importance of owning companies with strong balance sheets, ample cash reserves, and low debt levels. Let us take a closer look at some examples. Consider Microsoft. They boast a staggering $40 billion in cash and short-term investments, along with $59 billion in current assets. On the liability side, they have zero short-term borrowings and only $27 billion in short-term liabilities. Their cash and investment comfortably cover their short-term obligations, with long-term debt standing at a mere $10 billion. Now, let us shift our attention to Google. They have an impressive $113 billion in cash and short-term investments, while their short-term liabilities amount to just $69 billion. Their financial strength and preparedness for a downturn are evident. In contrast, take Royal Caribbean. They hold $1.9 billion in cash and $3.2 billion in current assets, but their current liabilities stand at $8.5 billion. This demonstrates the importance of scrutinizing a company's balance sheet, as Peter Lynch emphasizes. He advises us to be vigilant and watch the balance sheet like a hawk. He also highlights the types of businesses we should be keeping an eye on during these times. Look for fast growers or turnarounds. During a recession, stocks often become oversold due to institutional trading. This presents an opportunity for investors. As Peter Lynch explains, even a glimmer of hope can cause a stock to make a 180-degree turn. If a company goes from being crappy to semi-crappy, the stock can rise. And when it goes from semi-crappy to good, it can continue to climb. This is why identifying fast growers and turnarounds become even more critical during a recessionary environment. In his book, One Up on Wall Street, Peter outlines 6 different types of businesses: fast growers, stalwarts, slow growers, cyclicals, turnarounds, and asset plays. During a recession, it is crucial to focus on fast growers that can withstand economic challenges or seek out turnarounds that are beginning to see light at the end of the tunnel. By staying attentive to a company's balance sheet and identifying potential fast growers or turnarounds, we can position ourselves to seize opportunities and make informed investment decisions even during challenging times. Peter Lynch concludes with an essential anecdote about when to worry in the stock market. He advises us to be cautious when a company goes from great to terrific, because it often signals a downward trend. He highlights the euphoria we witnessed in the stock market in 2021, where companies associated with Web3 or trendy themes experience exaggerated hype, only to eventually face a decline. Peter's wisdom reminds us to watch for improvement and be skeptical of excessive optimism. In Tony Robbins' book Unshakable, he presents data showing that the S&P 500 tends to deliver strong returns in the 12 months following a bear market bottom. This insight emphasizes the potential benefits of investing during the early stages of an economic recovery. It is a reminder to keep an eye out of turnarounds. If the impressive returns chart of the S&P 500 doesn't inspire you to seek out these opportunities, what will? Peter Lynch discusses the concept of finding your edge, highlighting industries or sectors where things are starting to improve. Positive indicators such as the price of oil dropping or the addition of millions of jobs suggest potential areas of growth. Peter's optimistic mentality, which has served him well throughout his career, encourages us to remember that while there are challenges in the economy, it could always be worse. There are always companies that can thrive in any economic condition. He urges us to leverage our own edge, whether it is expertise in an industry, first-hand experience in a specific field, or even insights gained from everyday life situations. Your unique perspective can provide valuable insights that even Wall Street analysts may overlook. So identify your edge and use it to your advantage. And remember, never overlook businesses that are close to home. Peter emphasizes the importance of careful analysis before investing in individual stocks. He points out the inconsistency in people's behavior. He urges investors to examine the company and scrutinize its balance sheet. Investing based on mere speculation or the stock's upward trend is not a sound strategy. This classic Peter Lynch mentality serves as a timeless reminder to be vigilant and make informed decisions. During times like this, there will be an influx of opinions from various sources, including fund managers, media articles, and even your neighbors. However, Peter's key message is to refrain from acting on random information and to stay focused on diligent analysis and well-thought-out investment strategy. As Peter Lynch famously said, "Go back to the corporate filings. Go back to the financial statements. It is essential to do your own valuation and construct a solid thesis around a business. Can you explain why and how this company will be worth more in the future? That's the exercise Peter often talks about, and it shouldn't take long. And that wraps up everything Peter recent warnings for the 2023 recession. We'd love to hear your thoughts in the comment section below. What's the best piece of advice you've ever picked from Peter Lynch or his book, One Up on Wall Street? Share your insights with us. On the other hand, if you enjoyed this video, don't forget to give it a thumbs up and subscribe to Investing Path for more valuable content. Thank you for watching. This is Investing Path, and we look forward to seeing you in the next video.